Well, Nephili, we are starting to getting into the real stuff. Let's start from understanding the basic info. What are stocks? Stocks are like owning a slice of your favorite brand. It's a piece of ownership of a company, and shares is the quantity of that ownership.
Yes, exactly, Danai. Remember when our dad bought for us 1 share of Apple and he said, "Now you are part owners of the company that makes your iPhones. The more phones they sell, the more you gain."
Yes, I remember. I was so proud to go around and tell my friends that I am one of Apple's owners. There are, of course, millions and millions of Apple shares, but this was still a valid claim. But let's dig a bit more. Why do companies issue stocks?
Okay, that's a big question. A company may start by using money invested by the owners themselves. But when they want to grow, build more products, hire more people, open more shops, and so on, they may need to raise more money and be willing to give part of their ownership to others. They can sell this in a private way or go public and invite anybody to own part of their company. To do that, they issue stock in a stock exchange. The most famous stock exchange is, of course, the New York Stock Exchange. The single slice of stock is called a share, and there could be thousands, millions, or billions of shares. For example, Apple today has about 15 billion shares listed.
That's amazing. So the stock exchange is where people buy or sell their shares. In other words, trade their shares. In the past, people used to gather physically on a trading floor and shout and use hand signals to communicate buy and sell orders. Deals were made verbally and confirmed with paper slips. Nowadays, this is of course impossible due to the size of the companies and the number of people around the world that want to own their stock. So the modern stock exchanges are electronic, and you can buy or sell shares with the touch of a button.
Let's see an example. Let's say I want to buy Microsoft stock. We will use Yahoo Finance to search for that and see the current price. We can see that the share price is $454.51 when we did this video. You can buy only 1 share if you want, or a number of these. So let's say you buy 10 shares, you would need to pay about $4,545.
It's really important to understand that the price of a share is going up or down based on supply and demand, meaning how many people are willing to buy their shares and how many people are willing to sell. For an order to happen, there always need to be a seller and a buyer. When there are more sellers than buyers, this is when the price goes down. If there are more buyers, so more demand, then the price goes up. It's like anything else. The exchange does this adjustment automatically in real time. Why would there be more buyers than sellers, or the opposite? Well, that's another big question. There are myriad of answers. Some people may believe that the company has such a unique product and a strong brand, and they will continue to grow and bring more profits. Some others may think that wars and other geopolitical risks will harm the economy and will affect the sales of a company. So many factors affect the price of stocks on a daily basis.
Choosing which stock to buy and when to sell is really a difficult exercise.
Yes, it is. That's why in our practical module on how to invest, we give some ways people can manage this. Before we close, we just want to point that for someone to make money from stocks, there are typically 2 main ways. The first is when the price of the stock goes up. It's called price appreciation. The second is when a stock pays a dividend. Dividends are part of the profits of the company distributed to its shareholders. Not all companies give dividends, and even the ones that do not necessarily give them all the time. So this is something that investors need to research before making a decision. It could be a great source of income if done properly, and that's why some stocks are called dividend stocks.
This is great, Danai. This brings to the end of our brief journey in understanding stocks. Thank you for watching, everyone.